Welcome to Payroll Tax 101. Thank you for watching this presentation. You may be thinking, why is payroll tax important for a tax accountant to understand? I thought payroll companies prepared payroll and the income tax department prepares income tax returns. While that is often correct for small businesses, tax accountants often make tax return adjustments related to payroll, especially for clients who process their own payroll or maintain their own bookkeeping. Because of this, tax accountants need to understand the basics in order to discuss potential payroll adjustments, tax savings opportunities, and concerns with their clients. Hi, I'm Dawn Morgan, a proud USF undergrad and MBA alumni. My journey at Kirkering Barberio & Co. started with an internship in 2013, which has grown through several years of training and promotions to my current position as a CPA, working as a tax manager with the KB Healthcare Consultants team in our Tampa office. My work focuses on tax consulting, planning, and tax preparation for small businesses and their owners. I define small businesses as businesses with fewer than 20 business owners, even if their revenue dollars are significant. During my early experience with the firm, I often had difficulty reconciling payroll figures needed for the tax return and making adjustments needed to report the proper amounts. This presentation will cover several concepts which will empower you with a basic understanding of payroll matters which are pertinent to income tax preparation. So first, we'll look at the payroll tax effect on income tax. For individuals, the first piece that will impact payroll and the individual tax return is the W-4 form. The W-4 form is completed each year by an employee, and it is the guidelines a payroll company will use to determine an appropriate amount of payroll withholding from each paycheck. This form gives the IRS information about an employee's income tax return, including marital status, multiple jobs, which determines if extra withholdings are required because your overall income is in a higher tax bracket than just this job, dependents, which determines expected individual income tax credits, which impact the liability, and itemized deductions. So if you itemize deductions on your personal return, that reduces the individual tax liability, and therefore they will reduce the tax withheld from each paycheck. Completing the W-4 form accurately should result in a minimal tax refund or underpayment as it relates to W-2 income. Payroll deductions are another individual income tax impact because these deductions can provide income tax savings for the employee in the current year. We'll cover the payroll deductions further in a later slide. The next area that payroll tax affects income tax is for the business. Payroll accuracy is very important for business owners as they ultimately have responsibility for reporting the correct amounts on their income tax return, withholding and paying correct amounts, and filing payroll tax returns to the IRS and local tax authorities, as well as providing forms to their employees. If improper amounts are reported on the business income tax return, a taxpayer may be subject to an accuracy-related IRS penalty for overstated deductions or lose valuable tax deductions for their client if deductions are understated. If improper amounts are paid to the IRS throughout the year for payroll, the IRS charges 3 common penalties, which are on the left-hand side of the slide. Failure to deposit penalties are up to 15% of the tax due. Failure to file penalties are up to 22.5% of unpaid taxes. And failure to pay penalties are up to 25% of unpaid taxes. Wave Accounting shared a statistic that according to the IRS, 40% of small businesses pay an average of $845 in tax penalties per year. This is an avoidable cost if taxpayers are well informed about their responsibility. Income tax accountants can provide value-add services of answering client questions about payroll tax responsibilities and helping them troubleshoot with their payroll company and various tax agencies any challenges which may occur. So now that we have an idea of the income tax effect, we're ready to look at the various components of a pay stub. You may have received a pay stub before, so this may look familiar to you. And likely the first thing that you do when you receive your pay stub is you review the net pay amount, and you may ignore the various components which impact the difference between your gross compensation and the net payroll that you end up receiving. The top line, number one, gross compensation, is the amount of pay an employee agrees to with an employer based on a fixed salary amount, hours worked, or a commission amount based on percentages of sales. This can also include tax-free reimbursements for expenses such as auto miles or supplies reimbursement. The next component of a pay stub is the tax withheld from the employee's pay. Tax withheld for federal taxes is a result of your W-4 form that we just discussed. State taxes withheld have rules specific to each state. Next, we have other deductions. Other deductions may be pre-tax deductions or post-tax deductions. When we think about a pre-tax deduction, this directly reduces gross compensation before the tax amounts are calculated. Post-tax deductions essentially come from the net payroll amount. So for an example, if I were to receive $1,000 in net pay amount, and I had a $100 post-tax deduction, I would now receive $900 in net pay. Seems pretty easy, right? But if I had $1,000 in net pay originally, and I have a pre-tax deduction of $100, my net pay will increase slightly from the $900, the difference between the $1,000 and the $100, because I may have fewer federal withholding taxes taken out or Social Security and Medicare. So a pre-tax deduction will yield overall higher net pay, while a post-tax deduction typically yields a lower overall net pay between the two. In both cases, these deductions are usually a benefit provided to the employee in which they pay a partial share. We'll dive into these more in the next slides. On this example, you'll see we have a 401k deduction, which is a common deduction. Finally, putting that all together, our gross compensation minus the tax withheld minus other deductions determines the amount an employee receives as net payroll via a payroll check or direct deposit to their bank account. All right. So now after the pay stub, let's look at employee versus employer taxes. Some taxes are the same, and other taxes are only withheld by the employee, while some taxes are only paid by the employer. So on a pay stub, we only see the employee portion of the tax, which is all of the items on the left-hand portion of the slide, including federal withholding, state income tax, local income tax, Social Security tax, and Medicare tax, which collectively are sometimes referred to as FICA. You may have heard that word before. And employees who make over $200,000 per year, which are common for CPA prepared tax returns, will also have high Medicare tax on wages only over $200,000. The employer does not have any income tax withholding because that is the employee's payment, and all of it is withheld from the employee's check on the pay stub. The employer does pay into unemployment funds for both federal and state unemployment programs. These taxes are only paid by the employer. So if you look at an employee pay stub, you should not see unemployment taxes being taken out. It's only an employer cost. The employer also pays Social Security and Medicare tax in addition to the unemployment taxes. So you'll see in bright green, the common taxes which both employees and employers pay are Social Security and Medicare tax, which are both referred to as FICA tax. So that covers the tax piece. Moving into payroll deductions, let's look at some common pre-tax payroll deductions. One of the number one deductions you'll see on almost every tax return that you prepare is health insurance deductions. These deductions can include what we call health or medical, vision, and dental. These types of deductions require the employer to have met certain requirements as a Section 125 health plan for the deductions to be pre-tax. That's a legal issue which you don't have to worry about. When you see a payroll report, you'll be able to tell on the payroll report, it will say pre-health, pre-vision, pre-dental, which will indicate to you that these are pre-tax deductions. These pre-tax deductions reduce federal income tax withholding, Social Security tax, and Medicare tax. The next common deduction is a health savings plan or HSA deduction. You may have heard of this on an individual tax return where a taxpayer receives a benefit as an adjustment to their income. Another option which many employees choose to use is having these health savings account deductions taken right out of their payroll instead of being paid after the fact with their after-tax dollars from their personal bank accounts. If you pay these deductions through payroll, the payroll taxes are reduced on the payroll date as you go along, so you do not also get a deduction on your personal return, or it would be considered double dipping. What I mean by that is if you had a $100 deduction and you were in a 10% income tax bracket, you would save $10 and tax 10% of the $100 deduction right on that paycheck, which would then increase your net pay by the $10. Retirement plan deferrals to a 401k plan or a simple plan are deducted from payroll on a pre-tax basis unless they are noted as Roth contributions. Retirement plan deductions, except Roth, reduce federal withholding tax only. They never change your Social Security and Medicare tax. So if you had a retirement plan deduction of $100, it would only impact the federal income tax withholding bracket, not the Social Security or the Medicare. Shifting to post-tax payroll deductions, these, again, we want to think of as coming out of our net pay after all of the taxes have been calculated. So if I have a dollar for dollar deduction, that's going to reduce the net paycheck rather than reducing gross compensation and then the related payroll tax percentages. A common post-tax deduction you'll see are payroll advance repayments. These are a return of net pay issued before a paycheck date. So if an employee requests a paycheck ahead of the scheduled date because of an emergency or because they need the money for a bill which came up before they're scheduled to be paid through the company, the employer issues that check outside of payroll, categorizes it as an advance, which is an asset on the balance sheet. And then on the next payroll, we take that advance back from the employee and reduce the net pay that they'll receive on the regular payroll run. Because this is really a return of the net pay, not gross compensation, this deduction will not affect any of our payroll taxes. So if you would have received $800 in net pay and you have a $100 payroll advance, now you would receive $700 in net pay for this adjustment. Similarly, Roth retirement deferrals do not reduce any payroll tax liabilities, even the federal withholding. So a Roth 401k deferral is put in from the net payroll amount and it grows tax-free. And in the retirement phase, when those funds are taken out, they've already been taxed. So you can take it out tax-free, unlike a traditional 401k plan. A few other post-tax payroll deductions you may see but are a little less common include employee-paid life insurance and sometimes disability insurance. On the payroll reports, you typically see that with a post notation. So it's a post-life, post-disability. And that tells you that that deduction, again, is being taken from the net payroll amount. So now that we've covered taxes and deductions, let's talk about some common payroll tax forms which the employer must file. So we're all probably familiar with Form W-2, which lists the taxable income of each employee for federal withholding, Social Security withholding, and Medicare withholding purposes. It also includes the amount of tax withheld by the employer and any deductions which affect the tax calculation. This W-2 form you likely receive in January because it's due to the IRS in January of each year. The form above W-2, Form W-3, may be less familiar. Essentially, the W-3 summarizes all of the W-2s filed by an employer, and that form is also transmitted to the IRS so that they can reconcile the total of the W-2s to the amount deducted by the employer. Form 941 is the employer's quarterly federal tax return, which reports income taxes, Social Security taxes, or Medicare taxes withheld from employees' paychecks, as well as the employer portion. It also pays any remaining amount due for these taxes if they were not deposited with payroll. This form is due on the last day following the end of each quarter. So quarter 4 is due January 31st, just like several of these other forms listed. But the March filing would be due April 30th for quarter 1. So it follows every single quarter. We have to submit that filing as an employer. Form 940 is the employer's annual federal unemployment tax return, which reports the employer tax due for the year. It's an annual filing, so we only file this one once a year. And there's a payment made if we did not deposit this tax each payroll. It is common that this tax is paid at the end of the year. So it's not a bad thing if we're making a payment with the return. And this form is also due at the end of January. The last form listed is specific to the state of Florida. Form RT6 is the Florida Department of Revenue Employer's Annual State Unemployment Tax Filing. And that is the employer tax that is due. And that filing is submit quarterly. So just like the 941, we file that return at the end of each quarter and we submit any tax due with the quarterly filing. That was not submitted with the regular payroll runs. So all of this information is wonderful when everything works, but what about when it doesn't work? And you're trying to prepare a tax return and your payroll just doesn't agree. That's when we shift over into payroll troubleshooting, and we look at two common issues. The first common issue that we see quite frequently is that our wages are higher or lower in the general ledger that the client provides than the amount that's reported on the payroll tax forms. It is very important to fix this first before you proceed to any other payroll adjustments. The reason it's so important is because wages flow into every payroll tax calculation. If you start with the incorrect wages, every number after that will also be incorrect if you're relying on that as the accurate number. So the first step, if your wages don't agree, is determine your total variance. Then try to explain why you have a variance. So don't panic. Figure out the total difference, and then explore some reasons why it might be different. So one scenario is, what if you're preparing a tax return and your wages on the general ledger are lower than what's on your payroll tax filings provided by a client? I included quite a bit of detail here for you because really I think this is the bread and butter of this presentation and what would have been the most helpful to me as a new accountant when I was starting. So if your wages are lower in the general ledger than the payroll tax filings, it means that on the tax return, our wage number is too low. We can look in the general ledger to confirm that gross compensation amounts are listed in our wage accounts, not net pay. It's a good starting point because oftentimes small business clients reconcile their bank after the fact. So they pull in the transaction detail, which is only net payroll. And they click reconcile and they say, I'm done, my bank is reconciled, this is great. But we know that on the tax return, we should show gross compensation amounts so that the taxpayer gets the full deduction that they're entitled to. So if your general ledger account shows the net pay, we need to make some adjustments as the tax accountant so that our client gets the full deduction. The adjustments we need to make are recording employer tax as an expense and a liability, because it's not in the books at all right now. Employee taxes as a liability only, because that's their liability rather than ours. Employee deductions from payroll as their liability, so on our balance sheet a liability, and increase the net pay by the total of all employee amounts. To put some numbers to this example, let's say my net payroll per a payroll filing is $1,000 and my gross payroll number is $5,000. I need to increase my GL account $4,000 to bring it to the $5,000 that we should have. And I'll use the payroll reports to identify my employer taxes, employee taxes, and employee deductions to break out what that difference is. My next step after recording that adjustment would be to find where are the payments going out of the client's bank account for my taxes paid to the IRS and other agencies in Florida, the Florida Department of Revenue, and where are my employee deductions being paid. Oftentimes it will be in a general payroll account, but you'll have to search for each client to piece together where that is. Step one is confirming that it's net pay you're looking at, bringing it to the correct amount. And then step two is finding the expense payments and getting them in the right bucket so everything clears out. If you've done that and you've confirmed that your gross compensation amount on the general ledger account is correct and does match your payroll filing, but overall it's still not quite right, you can also check your taxable fringe benefits to confirm that they have been reclassified to wages in your general ledger. For example, for S corporations, there's a 2% shareholder health benefit for the owner that may be posting to an insurance account, but annually needs to be closed to wages to match the W-2. Personal use of company vehicle is a taxable fringe benefit, and that similarly needs to be adjusted. And so if that adjustment is missing from the general ledger and it's on your payroll reports, you would credit the auto expense or auto lease, whichever accounts the client is using, and you would debit wages to bring that back into agreement. And a less common taxable fringe benefit, but you might see it, is employer paid life insurance over certain limits. That's beyond the scope of this presentation, but if you checked that your net pay has been adjusted to the gross amount, you've checked your taxable fringe benefits and you're still off, you may want to see if there's anything weird about the life insurance on your payroll reports. And the last ditch effort, if you checked all of that and you're still too low, the amount that's going to be mapped to your tax return, would be to maybe look into January, look into the future and see if it's possible that the client made a mistake. And instead of posting a December 31st check in December, they entered the check on January 3rd when they were doing the bookkeeping and they forgot to backdate it to the actual date of the transaction. So that's a little bit less frequent, but sometimes you will see that as a posting error. So what if we're the other way? What if the amount that's supposed to be on my tax return is higher than the payroll tax filings? And I look at my general ledger accounts and I'm too high compared to the recap of the filings that the client has provided. Then it's a little bit more involved, but it's still not insurmountable. I would check first on my payroll reports to see if there's any non-taxable reimbursements paid through payroll. Sometimes the client will accidentally post these non-taxable reimbursements to wage accounts in the GL. So this includes auto mileage, not personal use of company car, but reimbursement to an employee for using their own vehicle for business purposes, office supplies reimbursements, things of that nature. They'll usually have REIMB, abbreviated reimbursement, in the pay type on the report. And if that is included in our wage number, we need to credit wages to bring it down to the correct number and debit the expense that it's reimbursing for. Another thing that you can check for, which is really a bookkeeping error, is that your 1099 non-employee compensation, NEC for short, payments that are paid through payroll and posted to the wage accounts in the GL. These payments are made to a 1099 provider who by definition is not an employee and therefore not included in our wage number. These payments as a result will not be included in the payroll tax filings. And to correct this amount, we would credit wages by the amount of our 1099 vendor payments and debit outside services, contractor payments, casual labor, or a similar account to bring our wage number to the correct amount and give the taxpayer the deduction for the vendor payments in the appropriate account. So if our wages tie and we think we're good to go, but we're still not balancing with the payroll filings, the next thing to look at would be our payroll taxes. So the second common issue that we see is that our payroll taxes in the general ledger are higher or lower than the amount on the payroll tax forms. As a reminder, the first step, very important, confirm that your wages agree before you touch common issue number 2. Your wages do not agree, I can promise you, you will have an issue in common issue number 2 because it flows from common issue number 1 that your wages don't agree. After you've confirmed that, If your payroll taxes provided by the client in the general ledger are higher than your payroll filings, we're going to look really for bookkeeping errors. So the first thing we can check is to confirm that non-payroll taxes, such as real estate tax payments, are not being included in our payroll tax general ledger account. Another item you can check is that no late payment penalties, which are not deductible, or interest payments to tax agencies, which is deductible but belongs in a different account, are included in the payroll tax general ledger. If you find these payments are included, it's very important that penalties are in a different account than interest, because we cannot deduct penalties and we can deduct interest. On the flip side, if our payroll taxes in the general ledger are less than our payroll filings, we'll want to look to confirm that our appropriate liabilities are accrued. When we say accrued, but we're a cash basis taxpayer, this is one exception. We always match the payroll tax filings, and I'll give you an example. So we talked about the payroll tax forms 941, RT6, and 940. All three of those forms can have payments in January of the following year for the previous year. So if on our Q4 filings, which are filed and paid in January, if we submit a payment for $250 with those filings, I should see on my balance sheet at 12/31, $250 that says I owe the tax agency $250. And that amount should also be included in my payroll tax expense general ledger. This is usually caught by the client before they send the information. But if you ever have your payroll taxes lower than the payroll tax filings, that might be a good place to look after you confirm your wages agree, after you confirm that all of your payroll forms are accurate. So that was a lot of information about payroll, some of which you may have already heard, and some this may be the first time that you've heard it, because we generally sweep payroll under the rug in our tax accounting studies because it can be slightly onerous and a little bit daunting to approach with so many moving details. The best practice overview for payroll taxes that I can give you would be first to understand the basics. This will allow you to request appropriate information from the client, reconcile payroll returns to your tax return, and resolve any differences which occur. I would also recommend confirming payroll amounts reported on the business tax return are accurate by requesting copies of the filings and comparing it to the amount in your client's general ledger. So doing a reasonableness check. You can resolve common differences using the payroll troubleshooting slides above and conferencing and supervising accountants as needed. Payroll is one of the more complex issues you'll deal with the first few years in accounting, and we don't receive a ton of training on it. So if you've gone through these steps and you're still stuck, I'm sure that your supervising accountant will be happy to assist you because they likely were also stuck in their first year doing accounting. And then lastly, share your knowledge with clients about potential tax savings opportunities through pre-tax deductions such as 401k plans or health savings accounts. So this last slide has a few additional resources, including the IRS website about employment taxes, which I've called payroll tax in this presentation, and the Florida Department of Revenue website, which is our SUTA state unemployment tax. Both of these websites have a ton of information in plain English about how each of the taxes work. If you're interested in learning more, I would highly recommend exploring both of these websites. Thank you for watching this presentation. It has been a pleasure sharing this with you. Tax accounting is a highly rewarding field with many opportunities to learn and share with clients ideas which save them overall tax dollars. While payroll tax is mostly handled by your future clients as employers and their payroll companies, a tax accountant with a fundamental understanding of payroll taxes will be able to move through tax return preparation quicker and be able to piece together how payroll taxes withheld from the W-2 flow through to the personal tax return. I hope this information will be useful to you in your coursework and the first few years as a tax accountant. Wishing you all the best in your remaining coursework and career. Go Bulls!